I think we approach from a geopolitical point of view, because I think sort of this one road, one belt initiative with China, trade flows, and all this is being renegotiated. And I think that increasingly leads to volatility, but also to large opportunities. And again, about the broad market, don't forget we're a very late stage cycle. And now basically you have an environment where you have not just monetary stimulus, but also fiscal stimulus, and that potentially could be inflationary. And that's also the debate in the bond market with the 10-year yield just at 3%, that many people consider the line in the sand to potentially more repricing in global financial markets. And that is exactly why the market is a little bit nervous these days. What if bond yields rise further? Would that lead to potentially a correction in equities and in corporate debt?
And talk about reasons to be nervous. You have a very dire prediction, 30 to 40% correction for US stocks. Investors are ill prepared, you say. Why are you so very pessimistic about the outlook?
Pessimistic. I would rather use the word realistic. And don't forget, we are a late stage cycle, and everybody has been conditioned to buy the dip. And that was the right strategy. Remember, it's a bit like the narrative that equities are cheap because bonds are even more mispriced. Now, potentially, you have a readjustment in the fixed income markets that over time most probably will lead to a higher cost of capital.
Well, what's going to drive that correction? Rates market volatility?
Yes, correct. And also, I think the belief, or the outlook rather, that potentially we're a late stage cycle, and that what if we have sort of a slowdown in certain parts of the economy going forward at the same time when rates are rising. That is very basically a more challenging outlook for corporates who are already very leveraged. And that's why increasingly in this environment, in our view, it's important to have a look at portfolio construction and potentially reduce passive ETF exposure to actively manage funds and investment managers who can actually take a bottoms-up approach. And also increasingly focus on valuation, because valuation, when everything is going up, valuations don't matter. When things become more challenging, how much are you paying for securities?